Good afternoon, everybody. Hope everyone out there is having a wonderful day. My name's Jean Baker, and I'm going to be your moderator for today's session. Today, we've got some really interesting information to go through with you. It's called the Futures Trading Guide. This is a project that Barchart's been working on for quite some time now, and we're really excited to introduce it to you today. The Futures Trading Guide was recently released to our website. And if you're familiar at all with our top stack picks, or even with the different bar chart trading strategies that you can see on our website, you know that we back test a number of popular indicators. Well, we've developed a very similar tool specifically for futures traders to use to find potential breaking trading ideas. And today we have John Rowland with us. Hi, John. How are you?
Hey, Jean. Thanks for having me back. I'm excited for today.
Yeah, good. So just to give everybody a little bit of your background, you've got quite a few years of futures trading experience. So today is really going to be your topic. You're going to be talking about the Futures Trading Guide and giving us all some great tips. John's been a futures instructor for a number of years as well, and really specializing in the energies market. The information that we're presenting today, it's really for educational purposes only. Any decision to buy, sell, or hold, or trade securities or other investments like futures does involve risk. This is information, education that we're giving you today, and not telling you to go out and buy, sell, or trade any kind of futures. With that, John, controls are turned over to you, and let's learn about the Futures Trading Guide. I'm excited to hear what you have to say.
I'm excited too, Jean. All right, so as Jean had pointed out, this is the new tool that is in bar chart, and we can be found under the Futures tab. And down here it says Futures Trading Guide, and we can click on the Trading Guide, and it's going to take us to this main page. Now, let's discuss what is the principles of this new technical analysis that is being presented to you guys. So what we're going to do is we're going to look at two moving averages, and one is the 9-day moving average and the other one is the 18-day moving average. And what we're going to say is that the 18-day moving average is going to be a base for us. You know, it's going to help us identify potential trends, and that the 9-day is going to be the signal. That's going to tell us when we're going to take a trade. Now, if we look at the rules of this indicator, it says that it's a hypothetical trading system that takes a buy position when the shorter term 9-day moving average crosses above the longer day 18 moving average, and it takes a sell position when the 9-day moving average crosses below the 18-day moving average. So it's more of a static indicator because it's being derived from two moving averages, a 9-day and an 18-day. So it's going to teach us to be a little bit more patient. And now what's the nice benefit about this indicator is that one of the things we're going to discover is that it's going to not only help us identify potential trends or confirm a change in momentum of our markets, but when it identifies some of these stronger trends, it's going to allow us to hold on to these trades for a longer period of time. You know, one of the adages that we hear in trading is, cut your losses and let your profits run. Well, that's easier said than done. Most traders, including yours truly, tend to hold on to losses too long and take our profits too quickly, usually because we're trying to cover our losses. But what's going to be really nice about this indicator that we're going to look at is that it's going to take that emotion out of our trading. It's going to allow us, give us permission to hold on trades for a lot longer periods of time. So you can see that this indicator is not really designed for an intraday futures trader. This is really designed for a futures trader who is going to hold positions from day to day, day to week, or week to week. And we're going to look at some results, and you're going to see that some of these trends that we're going to discover are multiple days, days into almost months. Now, what we also need to understand is that the indicator is going to give us a buy or sell signal. Now, if I have a buy signal that is put me into the market, then when the moving averages cross back over, it's going to create a sell signal. And the calculations that are defined inside of this page are going to be based on the opening of that position, or the settlement price of the day when the price closes or the indicator crosses over. And that the trade itself will not be closed out until the indicator crosses back over, and that would be based on the settlement of the day when that happens. But the indicator itself here is always going to keep us in the market. So it's going to show us a buy, a long trade, and then it's going to signal a sell. Now that sell is both a sell to get out of that long trade, or telling us that that trend is over, but it's going to start calculating a new trade based on the short side. So the indicator on this page is always going to be in the market. Now, if we look at these results here, you can see that there are some, right now, all of these open positions are giving some really impressive results. Now, remember, this is on a one lot contract, right? So let me go back to the full page here. So energies, crude oil up about $13,000. Financial bonds, up, $3,000. Grains, there's some nice little winners in there. Indexes, meats, metals, and you can see there are some really substantial profits here. So I want to stop at this one here, the NASDAQ, and what we're going to see here is that currently this trend, this buy trend signal that we got, has got us into a position that has now created a profit of almost $60,000, right? Here is our last price, how much price is up or down today. Our signal, our most recent signal, was a buy signal that was based on our crossover. And here we can see something called strength, which just tells us how strong our trend is compared to what it's been over the last year. What is the start date of this trade? We got into this trade back in April 2nd, and what was our entry price? $76.2650. Now I can look at the details of the trade. Now I want to also point out at this point that from this point on, anything below that main page is a premium service. So those of us who are premium members will be able to see all this information. Those of us who are not will just be able to see that front page that I was currently on. Now we can see here the details of this trade is that, we got in on April 2nd, and we have been in this trade now for 118 days. Again, what is really one of the benefits of this indicator is it's going to find some nice trends that we're going to allow us to hold on to this trade for a long period of time. On this chart, you can see here's a little B, or that represents our buy signal, right? And we are still seeing a nice upward trend here, right? And we have yet to stop now. Now we'll look at what's going on today in a moment, but many of us as traders might get afraid or nervous when price crosses over some of our moving averages, right? That might be a signal for us that it's time to exit a trade, right? Fear, right? A fear. But here we can trust this indicator to hold onto positions for longer periods of time. On this main page here, we do have some basic information, our contract specs, our point values, our days to expiration, our days to our first notice day, and our margin. Now we're going to look at first notice day. That's going to be something critical we're going to look at in a moment, and so I want to just point it out where it is. Some technical analysis will be available to you as well. The volume that is in it, what our average daily volume is, what our average trading range, 9-day, 14 days. These are technical analysis some of you might be familiar with. Down here, we see a 1-year performance history. So what this is telling us is that our indicator in the NASDAQ has identified 5 trades. But what it's really telling us, it's identified 5 trend changes over the last year. Not many trend changes in a year's time, but only 5 in this case. And that the average length of one of these trends is about 67 days. And the total profit of all 5 of these trades is $78,000. Pretty impressive if you think about it as in terms of this is only a 1 contract indicator. Now, if I go deeper into my history and I can break this down, these 5 trades down, now I'm going to look at the statistics of the data that are inside of each one of those individual trades. So 5 trades, an average of 67 days, and a total profit of $78,000. But here we can see we can broken down the 5 trades. In this most recent trade that we're in, we've been in for 118 days, and it's generated a profit of about $59,000, $60,000. And it says right here, OTE, that means that it's an open trade equity. We're still in this trade. Over here, it tells us what is the max profit this is. At some point, a few days ago, the NASDAQ was a little bit higher, and at one point we were at a maximum profit of almost $67,000, $66,000. The drawdown is going to tell us how much has price gone against us from the time of entry. So many times when we get into a trade, we might see a correction in the market where price will return a little bit lower, and that might create a potential loss. But here we can see the drawdown, this one was about $2,000. And this is going to be important for us when we do our risk assessments further on. But anybody here in this room, if I told you, would you be willing to risk $2,000 to make $60,000 or 30 to 1, I think everyone in this room would raise their hands. So let's look at these 5 trades. We can see that this one has been 118 days, this one was 35 days, this one was 135 days, this one was 18, and this one was 28. Now, of those 5 trades, we had 3 winners and 2 losers. Right? Notice that the losers are in trades a little bit less amount of time. And that's another thing that we're going to discover is that the longer that we're in a trade, and the theory of price is that with a greater probability we're going to see a positive or some larger results. Now let's look at this current trade that we're in. And here is the date of our entry, the April 2nd. And where's our B, our buy signal? And what we know from moving averages is that when we look at a moving average, that price generally stays above or below the moving average, depending on what the moving average is doing. For instance, here, an upsloping moving average, price tends to stay above because it's a delayed data, right? It's based on past price action. In a downsloping moving average, price tends to stay below. So what is the catalyst or the impetus that's going to create that change in momentum of my 9-day moving average? And typically what we'll see is that we'll see an impulse of my market, a change in price, an impulse in price. And if we think about trends, right, a trend is that price is going to continue, or momentum is going to continue in one particular directions. Now we know from trading that price doesn't just continue to go straight up, well, unless you're Tesla, right? But an uptrend, or trends, are a series of impulses and corrections. And so what the 9-day is showing us is when the 9-day crosses over the 18, it's identifying for us, it's confirming for us that first impulse of a potential new trend. In this case, the first impulse of an uptrend. And here we can see that playing out, right? Here was our impulse that got us into the trade, and there's our series of impulse corrections, impulse correction, impulse correction, impulse corrections of an uptrend. And an uptrend is defined by higher highs and higher lows. A downtrend is defined by impulses of lower lows and lower highs. So as long as my market is continuing to have the tendencies of the trend that my moving averages are indicating, then I'm going to rely on this indicator to let me stay in this trade for a much longer period of time. So let's look at crude oil, right? And we can see that in crude oil, currently, we have a position that was open in May 11th, and it's been giving us a result so far of up $13,000. That's pretty impressive if you think about crude oil, for those of us who trade crude oil. And here we can see that this current open trade we have been in this trade for 79 days, right? A long period of time for crude oil. And a lot of us would think about futures trading, we're looking at very smaller time frames, or we're only holding trades for 1 day or 2 days. Here, we're holding this trade for 79 days. Now, here was our crossover that gave us the entry, right? And you can see, if I'll blow this up a little bit for you, okay. Right, there's that impulse that came prior to a change in our momentum and our confirmation that this is the first leg of this uptrend, this impulse correction, impulse correction. Now, the initial part of this uptrend was pretty strong, but in recent weeks, we can see that the momentum of our trend has kind of slowed, right? And that's what I wanted to point out up here. Here we can see the strength of our trend as it looks at the current strength of this trend as it has been over the last year. And you can see that it says that our strength is a little on the weak side. And direction is going to give us, a snapshot of what is going on in our market in the last 3 days, and that says that it's been weakening. So it's kind of given us fair warning that this trend might be coming to an end, that bend at the end, so to speak. But still, we are still seeing that our moving averages are paralleling each other, and we're still in this trade. And you can see that there was many times that I might have been scared out or shaken out of this trade when price broke through some of my moving averages. Now, an advanced strategy that we could talk about, I'm not going to go into depth in this one here, is that the tendency of a moving average is that price likes to stay above it, right? Price likes to stay above it in an uptrend. So if I have a price action that goes below my moving average and then returns above it, well, that is confirming to me that that trend is in control and that price is going to continue to go higher, right? And so the advanced strategy we could think about here is, as price gets back above my moving averages, this could give me permission to add on to my position, right? Again, a more advanced strategy. And you can see that in the last, a month or so, there was 4 or 5 opportunities where I could have added on and gained a lot more profit in this trade. But again, we're just talking about a 1-lot contract scenario. Now, those of us who are experienced futures traders, we should be thinking about, maybe a little bit of a red flag here. Here I can see that I've been in this trade for 79 days. So this could be a problem for us, especially if I understand the life cycle of the market that I'm trading. And that in crude oil, a lot of you know that crude oil rolls over or has expirations on the contract months, once every every month. And so in this example here, if I was in this trade, I might be getting close to the time of expiration. This could be a problem for me, a risk that I need to be aware of. So I want to discover that with you guys together. So the life cycle of a futures contract is that at some point we are going to have to exit our trade. Now, if we are in a stock, we could hold a stock for as long as the stock is actively, that company is actively around. But in futures markets, we can't hold on to positions forever. At some point, we're going to have to exit that trade, right? So let me go back to our first page.
Hey, John, let me ask you a question. A lot of people asking, are these exponential moving averages, simple moving averages?
It's a simple moving average. Yes, it's a
Right.
very simple moving average. So what we're really doing is we're taking two simple moving averages, and what we're really creating is kind of a synthetic MACD, a moving average conversion diversion. So we're kind of making a synthetic MACD. Now, it's still a simple moving average. All right, so here I'm in the metals market, and actually, let me go back here. So what I want you guys to be aware is the algorithm that is creating these signals for us in these particular markets is using what we call the front month, the first contract that is closest to expiration. So it's important for us to understand that we could be in a trade, and we could have been in this trade for a long period of time, but we might be coming to the time of expiration. And so we might need to do some mechanics to allow us either to hold that trade or maybe tell us to exit that trade. And so expiration is definitely one of those mechanics that I need to be aware of. Now, for most of us, we're not going to be allowed to hold the trades all the way into expiration day. The more critical element for us is something called a rollover. Now, rollover for most of our markets is based on a liquidity issue, but first notice day is really when we see a rollover. Markets like agricultures, metals, softs, you'll see that the first notice day is well before your expiration date. Markets like oils and indexes, the first notice day will be at expiration, or maybe even after expiration. So that would be a liquidity issue for us. We would wait for when the volume of the forward contract goes greater than the volume of the most active one, or the one that's going to expiration. So it's important for you, if you don't understand rollover and you're a futures trader, you need to understand this concept. So here we are in gold, and we can see that our first notice day in gold is July 31st. In other words, Friday. And so if I'm in this position, this August gold position, and I've been in it now for 41 days, by Friday, I'm going to have to get out of this trade. Now, there's many reasons why I'm going to get out of this trade. One of them is that, if you own a position inside of first notice date, that you could be assigned delivery. That's something us as speculators, we don't want to do. But the real reason is that most of your brokers are not going to allow you to own a position past first notice day, because it puts them at risk as well. So you're going to have to exit this trade. So what can we do here? So we have two options here. We can hold on to this trade, right, up until first notice day and just close it out and take that trade as is. Or we can roll to a forward futures contract and to continue that price movement. So one of the nice things that bar chart does for us is, if I go to the individual tabs of the market, it's going to give us a couple of options of what months that we can roll forward into. And so you can see the August contract is the first contract that's going to expire, and it's telling us we could trade the October or the December contract. Now, I would go into look at some statistics like volume and open interest. And if I looked at that liquidity issue, we would discover that the December contract has the most volume and open interest moving forward from the August contract. And in fact, you can really see here that, open interest is already in the December contract. The volumes are about the same between the August and December. So that's telling us that we should move into that contract. So I could exit my August position, or I could roll forward into the December contract. Now, what's important for us to understand is I want to make sure that the picture or some other form of price evaluation is going to allow me to own that position. Here is our August position, and here is our trend, and you can see this is a very strong trend. And I'm sad that I have to get out of this trade, because I could see a lot more potential in this trade, but I've run out of time with this contract. If I look at the December contract, right, I'm still seeing those impulses, an uptrend impulse of higher highs and higher lows, and so it's telling me I can still stay in this trade. So I'm going to, at this point, I'm going to exit my trade in the August, and I'm going to enter a position in the December contract. Now that might not always be true. When we start looking at other markets, especially those of us who are familiar with markets that might have changes based on fundamentals or seasonality, especially our agriculture traders will be aware of things like this, that the story that we're going to see in the forward contract might not be the story that is being presented in the contract that is about to expire.
Okay, John, I've got a question from one of our attendees that kind of applies to what you're talking about. So does rollover mean that you should sell and buy again with a longer expiration date? Is that what you're referring to?
Exactly. So we want to make sure that whatever contract we pick, the forward contract, we want to make sure, I'm clicking on the contract specific, we want to make sure that the average length of our trade, right, 20 days, 30 days, 50 days, 70 days, do I have enough time to allow myself to take advantage or appreciate from that longer trend? And you can see that my first notice day in the December contract is 124 days away. So if my average length in this market is 30 to 40 days, then there is plenty of time for me to stay into this contract. And maybe even if this trend continues, I could see, the potential to holding on to this trade for up to another 124 days. So that's important. That's a great question. We want to make sure that we roll forward enough that allows us to take advantage of these greater trends at times that we're in a trend. Okay.
One more question, if I can, because this one's coming up quite a lot from a lot of our attendees. So if you're using open and close, are you using Globex or regular trading hours?
Okay, so it's not the close, it's the settlement price, all right? So I want you guys to realize that. And the settlement price is established at the end of what we call the regular trading hours, or the business hours of the exchange. Now, when you go into your contract specs, you will see that they will make a distinction of what is the regular trading hours. For grains, you guys close around 1:30 in Central Time. For metals, it's a variety of times for you. I think you guys in Midwest, it would be anywhere between 12:30 and 1:30, depending on the different metals. I think crude oil closing range is around 2:30 Eastern Time, so that's 1:30 Central Time. So there are different times that the settlement prices will be established. The settlement price is established at the end of the closing range of regular trading hours. All right, so here we are in the grain market, right? And what I want you guys to see here is, for instance, in soybeans, right, our current front month is the August contract. And you can see that it was a buy signal, and it was entered in around June 4th, and currently that position is up $1,262. Now my strength is kind of soft, right? But let's look at our details on this trade, and we can see, like we saw in the gold example, is that our first notice day is this Friday as well. So will I take this position forward? Do I want to take this position forward? So I'm going to have to pick a contract month that is forward from the August. And anybody who is a grain trader and trading soybeans, right, will know that what are our options? Well, we could go into September, or we could go into November. And if I did that liquidity evaluation, we can see that the November contract is probably the better contract for us. A lot more volume and a lot more open interest. And because it's the November contract, it's a long time before my expiration. I wouldn't have to worry about expiration and rollover until about Halloween. So here's the thing. Do I want to continue to holding this position? Am I going to see the same story like I did with the gold market? So here is our August soybean contract, and we see a nice moving uptrend where we see higher highs and higher lows, right? And here's our our 9 and 18, right? Still in this trade, even though recently we do see price has retreated. Here's our impulse, here's our correction, right? But if I go to my November contract, what we're seeing here is a different story. Now, I've done some manipulation to this chart to kind of give you guys this concept that just because I'm going to roll forward doesn't mean that I'm going to see the same picture that I saw in the contract month that is about to expire. And so what we see here is, yeah, my market is still showing me tendencies of an higher or uptrend, higher highs and higher lows, but in recent weeks, we've bumped up against resistance. We had that correction that gave us a sell signal. And then price popped back above and then gave us a buy signal, but it failed to make a new high, right? It's not making the things that we would anticipate with an uptrend. We really would have liked to see that make a new high, and it didn't make a new high. Matter of fact, it made a lower high, which is one of the tendencies of a downtrend. Now we're kind of stuck in the middle here, aren't we? Is this trend line about to break and price go below here, or is price going to get back above my moving average and take out this high and go above here, right? So at this point, just because my indicator is telling me I could still be long, right? The picture here is not jiving with me. I'm not really enthralled with this trade. I'm really kind of lost in limbo here. And that's why it's important for us to understand our markets, right? Understand our markets. Here's our historical, right? 17 different trend changes in the last year. That's a lot more than we saw in the equity indexes. When we look at all those trades, look at in the last few weeks, how many of these trades we got into that didn't really give us a long period of trends, and all of them were stopped out for a loss. Plus, what we can see here is that our maximum profit on our entries never gave us a profit. In other words, we got the signal, we took the closing price, the settlement price, and the next day, market didn't even reward us. It actually moved in the opposite direction and eventually stopped us out for a loss. So here is one of those tendencies that we can start looking at. How is this indicator working inside of my individual markets? And also, it's kind of telling me here for soybeans to market, I might get a buy or sell signal, but I might want to wait for some other kinds of confirmations. In the case what I just showed you is I'm going to wait for that picture, that the enhancement of an uptrend, a higher high, right? I'm going to wait for that breakout when we take out that previous high, or I'm going to look for, when price impulses and breaks my trend line. Now look at the ones that did work, the ones that did have results. So 29 days, 34 days, 30 days, 39 days, 52 days. So the lesson to be learned here in the soybeans market is patience, right? So I'm going to get a buy signal, right? Or I'm going to get a sell signal, but I want to still be patient. I want to make sure that I'm seeing other things that are going to allow me to take that trade. Right? I'm in an uptrend, but my moving averages haven't crossed yet, but they've turned. So I'm getting mixed signals here, right? So this is a market that's telling me it's kind of in a transition, or maybe even in a sideways trend. And you can see that, over the last, 3 or 4 months, this market has been very, very choppy. It has been directionally moving forward, but it's been choppy. So this might be a market where I might need to be a little bit more patient with, right? Let's sum up what we've learned today. The trade guide here is based on 2 moving averages, the 9 and the 18-day moving average. It's going to teach us patience. It's going to teach us patience about entries, but it's also going to teach us patience to allow the market to trend out, to allow us to hold positions for longer periods of time. The caveats we need to make sure is that when we get a signal, a buy or sell signal, in the month that it's being created, do I have enough time for that trade to play out? In other words, will the time between my rollover, my first notice date, and the average length that I'm in a trade, will it allow me to continue to hold that trade? And what forward contracts that I'm going to trade, I want to make sure that they're showing me the same story that that market is telling me. If I'm looking at a rollover situation where I'm going to try to hold a position for longer periods of time, again, I want to make sure that the story that my market is showing me in the front month is the same story that I'm seeing in the forward contract. So, very powerful tool in our arsenal. Again, this is a guide. We're going to use this with other tools in our toolbox, part of our trade plan, part of our strategy, right? We're not just going to take these trades as is, but when this indicator finds a potential trend, and that trend is a strong trend, it's going to give us some very impressive results. Okay, Jean, is there any other questions, or any questions that are popping up now?
Yeah, we have a number of them. As long as you're right here on the trading guide, where are the currencies?
A bar chart had back-tested currencies, and they found that the results for currencies wasn't as good as we saw, let's say, in the commodities. So they didn't feel that it was a good indicator for currency. So we don't have currencies in there.
A lot of people asking, what time frame are you using on these charts?
So the time frame on these charts I'm looking at a 6-month time frame, but these are daily bars. Now, I believe in the theory that I want to stay contract specific. There is a way I can change the different charts. Notice I'm in a daily chart, 6-month time frame, but I also could change it to what was called the daily nearby, which would then show me a chart of the the front month contract, continue to hold that until we roll over to the next contract. But I really want to look at the price data that is unique or specific to the contract month that I'm actually trading. So I'll use what is called a daily chart, not a daily nearby. Now notice, I'm just going to give you an example here. Here you can see for this September contract, the low back on April 22nd was $21.79. If I go to a daily nearby, right, look at the price of the contract that was trading back in April, its low was $6. So I'm getting kind of false data, right? I'm not really seeing what is relevant to me for the contract that I'm actually trading. So, that's that's a great question, a little bit of a tip for those of you who are futures traders, okay?
Okay, another question for you then. A few people are asking me, how do you figure out the cost of buying a contract? And I think you were showing before the contract specifications, how many units make up a contract. That's kind of what people are asking.
So here, for instance, here we can see the contract specs for us of, for instance, crude oil. Now, what we have to understand is that futures are not like in equities. We're not putting up money to actually buy barrels of crude oil. What we're doing is we're entering into an obligation, right? And that obligation is how the futures contract is derived. So here's how it's priced: 1 cent per barrel, and every 1 cent change in my contract, the tick size, will change the value of my contract by $10. But if I'm going to purchase a crude oil futures obligation, then I'm going to have to deal with something which is called, let me go back to my futures page. Something is called margin. And margin is a good faith deposit that we're going to put up to allow us to hold that futures obligation. And you can see the margin for crude oil is somewhere around $7,500. So we're not really purchasing bars of gold. We're not really purchasing barrels of crude. We're entering into an obligation, this escrow, this good faith deposit. And for me to purchase one crude oil futures contract, I'm going to have to put up $7,480. That is what we call initial margin. But if for me to maintain that position for multiple days, then I only need to maintain inside of my account $6,800. So we're not really purchasing oil contracts. We're not, barrels of oil. We're not really purchasing bars of gold. We're not really purchasing cows. What we're doing is we're entering in an obligation, the construction of the futures contract, and what we have to put up, that good faith deposit, is margin.
But I think we have time for maybe one more question here, and this one again is coming up a lot. Does this work with contracts other than the ones that are shown on the futures trading guide, like micro contracts and commodity spreads?
So a micro contract is really shadows the larger contract. So yes, we can use it in the micro contracts. The values are going to be a lot different, right? So for instance, in the NASDAQ where we were up $60,000, a micro NASDAQ would only be up $6,000, right? Because it's 1/10 of it. So yeah, can we use it in the micros? Yes, we can. The values might be just a little bit off, a little bit different, because micro contracts have a little bit different liquidity. The caveat I would say to you is, make sure you know your markets. And in micro markets, I want to make sure that I have enough volume and open interest to sustain my trading. Micros in the indexes are well developed. Micros in, for instance, gold and crude oil are good markets. But micros in some of the more exotic markets, they are very thin in volume and open interest, and so you're probably better off trading the larger contract, because that illiquidity is an added risk.
Right, and just to show people how they would get to that, let's say they're looking at the NASDAQ micro, the NM contract. It's not going to be on the trading guide or on that historical performance page. But if you go directly to the symbol, like NM Yeah, right there.
Where is it? NASDAQ
There's,
Micro. Yeah, there it is.
right. And then on the left navigation under technicals, there's a trading guide for those micro contracts.
Okay, great.
Yeah. John, we are getting close to our wrap-up time here, and there are additional questions. Some of these are very specific, and what I would like to tell everybody in the audience is that if you have a question that maybe you haven't had sufficiently answered, just send an email to support@barchart.com. Our support group is happy to help you. Again, we're not going to be able to give out specific trading advice for specific contracts, but we'll do our best to help you get to learn the futures trading guide and find good ways to put this in place with your daily trading plan. So one other thing I want to let everybody know is that to use the futures trading guide and to get all of the historical back testing and trade details, it does require a Barchart Premier membership, but as you can see on your screen, we offer 2 levels of membership. There's a basic free membership. With Barchart Premier, if you are not already a member, or if you haven't tried it, or if you have and want to try it again, sign up for a free 30-day trial, and it's very simple to do. Check out the Futures Trading Guide and see if it can help you in your day-to-day trading. So with that, I want to thank everybody for your time and attention today. John, thanks very much. You presented a lot of information, very clear, very precise, and your background in futures trading certainly brought a whole new dimension to our webinar here today. So thanks, John.
Thanks for having me. I really enjoy these times together. Again, Jean, thanks for the privilege to be with your subscribers, and I hope that everybody feels like they've raised their bar in their education towards futures trading.
So thank you again, everybody. Stay healthy, stay safe, and we'll see you next time. Thanks for joining us. Bye.